Okay, good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, June 4th. Good morning to you all in the room. Aurelian, Iman, Jay, Kamal, Paulo, Pete. Great to see you guys here. Well, God has granted us volatility, and it's a great way to start the week and start the month. Lots to look at here. Iman says, good morning. Wish all is perfect with you. Thanks, Iman. Good to be with you. On the menu, we'll start off real quick with DXY and Euro on the aftermath of this reversal and see exactly where we're trading on those trades. Updates on the Aussie CAD holding a decent range into the start of the week. Dollar Yen coming into some support. Dollar CAD and gold with a big move, 4% off the lows just that we made late last month. We'll take a look at crude prices, which are also on the move. It's a messy chart, but I think we do need to be mindful of where we're trading. And Pete, I see you in the room, so I'm going to already put SPX right on the list there. Those levels continue to work out pretty well. All right, any other questions or trade setups? As always, feel free to throw them on the message board at any time. So as far as data is concerned, real quick, we do have some commentary coming out later today with Powell's discuss monetary policy strategy at the Chicago Fed conference. Whether that'll move anything or not, we talked yesterday, if you guys were with me in the Daily FX webinar, how markets have essentially priced in 90-some% chance that we're going to see some sort of interest rate cut by the end of the year. Now, the 60-50 split, the 60-40 split, I should say, is starting to lean more towards 2 cuts. There are people calling, I'm not sure if I think it was Barclays yesterday, was calling for 3 cuts this year, or 2 cuts, one of them 50 basis points though, so 75 basis points total. Point being, the move that we've been waiting for in the dollar for so long has materialized, and lo and behold, interest rate expectations have started to also finally deliver what price is showing. So further conviction on it. Here's where the DXY stood back on the 21st. Okay, this is going way back in history. Just wanted to highlight this weekly chart with what the weekly chart's doing now. It's the same exact thing. I showed you guys this yesterday as well. That slope is ridiculous. Okay, week and a half, 2 weeks later, here we are, still holding that same slope, never made a close below, moving to the downside. There's that blue slope we've been watching. It's your first sort of level on the larger term weekly charts. On the daily charts, this is what it looked like last week as we were probing those highs. Here's the daily chart now. Whoops. Okay, we did probe, push through, never made a close above that same gradient. Okay, here's the close, outside reversal day never got challenged, and here's the move to last month's opening range low. Okay, we made it on the 13th of May. That's 97.03, that's where we're sitting right now. Intraday chart, well, we've switched a lot from here, but just to show you, that 98.30 level, we didn't quite get that 100 before reversing, and here's what the chart looks like now. Obviously, the 60 momentum resistance hold, we talked about that yesterday as well. Now, I don't have that much conviction, okay, on this slope, just to be clear. I have it just as a reference to kind of give me a view. If you take a look at these lows, they kind of match, not really, but point being, a basic 236 to the decline off of last month's high gives you 97.32. Just higher, the 38.2 comes in on the May open. That converges on a decent slope there, that pivot that we made in the start of the week, and that gives you 97.53, 97.52. So that's sort of the extreme of which you would want any advance in the dollar to hold. Okay, we're going to call that our near-term bullish inval, or bearish inval, excuse me, just higher. I do want to highlight the weekly close. Okay, so if that materializes, you're basically looking for a resumption. This whole thing could be a fake out. Not my favorite scenario, not what we think is going to happen, but certainly we have to have those invalidation levels well defined. Downside move is where things get tricky. If we move lower from here, okay, you have that dominant red slope longer term, and that converges on the downslope somewhere just under 97, like 97.80s. A 618, okay, of the entire advance gives you 96.73. So levels to be mindful of, it's tricky here. I'm going to show you the euro, I'm going to show you the Aussie, all of which are also holding near-term extremes. So on this move, like I said in yesterday's update, the tendency is inclinations kind of just jump in. I want to be short the dollar, but timing is everything and the setup needs to be there. So at this point, ideal scenario is we get some sort of recovery to get us back in. But let's look right at the majors from here. So here's where we stand on euro. Okay, and here's where we stood last week. This was back on the 29th. Euro dollar weekly chart had us probing below this pitchfork support, slope support, whatever you want to call it, has been instrumental in every pivot break in the euro so far. Couldn't do it. Couldn't do it. We did not close the week below. We closed the week right there. 1186 has still continued just to been a level that we're straddling. I have it on there for reference. But if this advance in the euro really starts to clear some downslope resistance on a weekly basis, we're talking about something happening here. Ty says DXY combo, please. Yeah, sure, Ty, here it is. Got it? So for the euro, the focus was for a close below that line. We couldn't get it. But what I'm saying is if we start to clear some upslide slope, so this is the slope on the weekly chart, just off the highs that we made in early 2018. On the daily chart, we're using a different slope, but the magnitude of trend matters. Okay, so this is going to matter what it looks like on a weekly close because we have not made a weekly close above that slope. On the daily chart, here's euro. A slope just off of this year's highs that we made in January, and then again tagged in March. That parallel seems to be pretty decent with the lows that we made in January and March as well. That's really the bigger area that we would need to clear on the daily chart to get this thing going. Now, a 618, I don't really want to stress this 618 because it is not arbitrary, but it's taken off the March high, converges along that slope, and then you also have 113, 112.99 right there, which has been a huge pivot in price as well. That's sort of the major resistance range on the daily chart we need to get through, okay, to validate a larger breakout in euro. Until we do, we're focused on this. And this is the same chart. There's the weekly marker from yesterday, last week. Same chart from last week. Here's what it looked like. Our focus was whether we were going to get a close below 111.30. You guys remember? We were talking about that as our bullish invalidation. We had slope support there, 786 retracement, just a really nice spot. Former slope resistance, turn support, really nice spot for this thing to hold. It did give a fake out. It dipped as low as 111.15, 111.16 before ripping right through. And here's the resultant break. Take out all these top side targets, including 112.40. Okay, so where do we go from here? Well, again, the slope hasn't been that clean from here, but what I wanted to just focus on was a break of the May opening range highs. We have not really seen a close, 2-hour close above that. We posted, well, it was almost an outside reversal candle off the high. Could get some more kickback. No surprise, right? DXY, we just looked at that, could get a little bit of bounce off of its May opening range low. So use some caution. These are the markets where people really get sliced up in. So stay nimble. By all means, if there's a decent trigger, you can try to take the pullback. From my standpoint, I'm more interested in looking for this pullback, a larger correction to get back on the long, to see if we can't get this breakout going. But you had some divergence into the highs. No surprise to see a little bit of a pullback here. Now we have to rework these levels because this range has essentially been invalidated. So we're going to drop that 618. We're going to drop this extension, clean this up a bit. And what I want to do is just take a basic retracement. Okay. Give me one sec, guys. Bear with me. I just want to see if we have any other slope we can work with here. Okay. I'm working with a 38.2 parallel here just to see if we can't find support above 112.15 would be the ideal scenario on this drop. Bullish inbound would have to still be 1186 at this point, so down here into 1177, this 10 pip range here. Price needs to hold this zone if this breakout is legit, just on account of the basic trendline resistance that we broke from the high that we made back in March. So a little bit more, it was a 3-point touch, it was a decent break, all of that kind of converges down here on this 10 pip range. So if volatility follows through, we start to see a larger dollar recovery, that's where you'd want to see failure in the euro. A breach above here, 1298, but like I said, 113 is basically your near-term target on the upside. We'll have to follow slope from there, but it's a huge region that we're talking about in the euro. So could be on the cusp of something nice. Nothing really has changed. Still in the range, just about a little volatile release, says Ty. At the same time, interest rates are wild. Ty, I wouldn't necessarily say nothing has changed. You know, we started the month, or we closed last month, attempting a massive break in euro on the weekly chart, in DXY on the weekly chart, and both of those held. So we're seeing the shift in interest rates finally starting to materialize more so in market expectations. I mean, it kind of just jives. I agree with you that at the moment, chasing this would be foolish because, again, the move has been pretty rapid. You got a lot of people who are going to try to jump in and chase this thing. That's usually when the markets start to rip people's faces off. So, again, we're early in the month. I'm super cautious right here. All my positioning has been super little, well, not super little, but smaller than, you know, my average lot size, just as we feel out the markets early into the month. And I think we're going to get some decent moves. I mean, if things follow through, like I said, with how we started, it's going to be a great month. So that's Euro and DXY. I'm actually not operating on either of these, but definitely wanted to cover them as we start off the week here. Any questions? ECB's on tap. You know, we'll see whatever comes out of that. So that's on Thursday, and I'm not going to see anything interesting come out of that. But we'll have to wait and see. Okay, so that's 1 and 2, DXY and Euro. Number 3, here's where the good stuff starts. Aussie. RBA cut interest rates as expected last night. Here's what the Aussie looks like just on the weekly chart. There's not really a lot to look at here except the continued highlight of 70.20 in the 70.42. It's a level we've been watching for a while. Yearly open, objective range, 50% retracement of the yearly range as well. So a really nice pivot in price. It was the onset. Once we closed below that on a gap, it was point in fact. That's when you got the extended move. That's the huge pivot that we're looking at. Same as the lows that we made last year. Just a nice level. So longer term, that's the Aussie implications. On the near term charts, coming in some really hairy areas. And this is why I'm very cautious to chase the dollar from here. Here's what it looks like on the daily charts. And this is what we went over last night. So 100% extension, if this were to be just corrective, is 69.72. We've already sailed through that. We've closed above that. We hadn't yesterday, so I wanted just to highlight that. And this slope that we're looking at, if you take it from the extended high that we made back here, still continues to highlight the next upside target into the 70 handle. But from here, here's the caution. Slope on the advance, which has been pretty decent. Here's Aussie, just a quick reminder how we super clean on this decline. I mean, literally, it was textbook. 50-line support, 50-line break. There's the upside break. Took a little while to materialize with the momentum, but here it goes, right? Slope resistance seems to be holding this. You have a 38.2 just higher, 69.95. You got the low day close for this year. Don't forget, despite the drop that we got, the yearly low executed on the 3rd of January, and that close date, still a decent pivot in price, matches up with the lows that we made back in March, converges on slope. That's all at 70. So we could butt up into here a little bit more. Last night's RBA interest rate decision, again, charged a massive drop, quickly recovered, okay, to challenge the highs again, but I'm not buying it. Okay, you got some divergence here on the 2-hour chart. There's some divergence on the hourly chart. You're heading into slope resistance. You have a Fibonacci consideration and the low day close. So you're looking at like a 10 pip range, just higher, of which to be very cautious of. The levels really haven't changed as far as the intraday. I'm gonna dump this 100. Okay, kind of follow this slope. I don't want to necessarily stress 69.44 as much as I do this slope, because the median line has been pretty decent support right there. So pullback levels of interest. Okay, pullback levels of interest. The breach, like I said, needs to get through 70 to get this thing going. 70.42 is the yearly open, and that's the top of the big range that we talked about on the weekly chart. So Aussie, look for very similar scenario to Euro. Okay, vulnerable for a pullback while below this 70 handle. Ultimately, we want to find that corrective so we can get back on the long side, but you're pressing the top, not necessarily the range, but the top of the upslope that we've been in. So I would allot some room into 70, but I'm basically looking for resistance up here near term. And again, if it breaches, and this is something that we've seen on a couple different pairs, a breach of an upslope will typically be the sharpest part of the rally if we top 70. Same thing on some of the other pairs that we're looking at. Okay, if we're moving down in the descending channel, the break of that downslope will oftentimes be the sharpest part. So we'll have a good breakout if we do get it, but ultimately on this move, I still think you're vulnerable for a little bit of a kickback. Questions on Aussie? An interesting cross that I highlighted that we've been following since last week, and I wanted to highlight before the RBA, was Aussie CAD. Now that one hasn't necessarily made a big move this week yet, but the levels are super clean. Last night we highlighted 93.15 to 93.60, a 10 pip range to look for support, and that was the range that we need to break to get a larger pullback in Aussie CAD. Okay, we held. We dipped into that region, tested it twice. Okay, here's what it looked like last night. Here it is. Late last night we tested it, and then on the RBA again, came even closer to slope, right in the middle of that range, 93.55. Now the weekly opening range is set. Okay, so if we do see a topside breach, still want to see 94.08. It's basically the weekly opening range highs, but you know the 50% is there. You have slope there, so watch for a break there to really unleash it. You'll have room. 94.56 is the upside target if we do break that. Major 618 median line would converge there. Really nice level, very clear. Excuse me. If we get the corrective pullback, which is what I was initially thinking earlier in the week, then 93.21 would be where I'd clean most of that up, and then I'd leave a little on, see if we can't get 92.75. But the weekly opening range is set on this trade. It's interesting because when we look at the dollar CAD, which we'll do just in a moment, you'll see the resemblance on how if we get them a definitive move in Aussie and CAD, I think this one will play out pretty well. So yeah, sure, Ty. Here's the Aussie combo. And here's the Aussie CAD combo. Okay, any other questions on either of these Aussie crosses? No change. Really nice weekly opening range taking shape. It's Tuesday, second day of the trading month, calendar month. Let's look for a near-term breakout here for some directional guidance on Aussie CAD. Next up, I was going to do dollar yen, but let's just do dollar CAD. Both of those were highlighted last night, but this one's coming into that same zone. You guys remember the level? We talked about it all throughout last year, all throughout the start of this year. We've been straddling it for the last 6-7 weeks, 34.37 into 34.35. It's same key range, 618 retracement of this year's range. It's a 2017 open, really decent pivot in price. So the weekly charts, you're in no man's land. You're right at the top of the range, momentum holding 60, not the most bullish advance if this is going to be a larger move higher. Dollar CAD on the daily chart looks like this. Okay, so this slope that we've been following off the lows, the same gradient appears when you take a pitchfork off of the advance from this year's low. That same slope, a parallel of that, caught the lows that we made in May. And here we are testing parallel support, which, although we've had many wicks below, never saw a close below on a daily basis. So we're still within the confines of this pitchfork. And here's that major pivot. And look at the closes. Yeah, you might have got one above, but here's a perfect pivot. Break saw acceleration, acceleration, pivot, pivot. Here we are again. All that converges. 34.37, 34.35. We're there right now. Intraday chart. And note how we reversed off of that 35.37 level. Intraday. Momentum holding 60. Intraday looks like this. And here's what we looked like last night. Daily and intraday. Okay, so the level of concern, the level that we've been citing, the level I was kind of like, I'm not doing anything into this level. Any shorts that you're holding, you want to clean them up, stops to break even or better. Any positioning you're looking for the immediate, I wouldn't attack the long side just yet, but that's where we're vulnerable. Okay, just look at the pivot that you've seen in price along that horizontal level. Again, the slope being there adds some flavor to it. There's resistance was a decent slope. Break, acceleration, support, lower parallel, a little bit above, a little bit below, but we're trading there right now on divergence into the lows. If the break happens, it's going to be accelerated. And if it accelerates for another leg lower, you're looking for monthly open, 33.88, and the 618 comes in at 33.70. 18 pips between the two. So those are your next downside objectives if this thing gives out. There's no downslope to work with. That's respectable. I was checking it out last night. There's just nothing there. So we'll see if we can't get some play on this heading into the open of US trade. Okay. Ideal scenario is you get a little bit of a bump. Maybe failure at this really near-term slope. I hate using these short slopes, but ahead of 34.85 would be the play. And then you'd look for the next extended move lower into 33.88. If you're holding shorts from anything north of 34.85, I would put my stops just above that. It's sort of my near-term bullish inval. So interesting stuff on dollar CAD. Don't forget, dollar CAD has a decent week of data ahead of it. Friday's double whammy employment data. So you get U.S. non-farm payrolls and Canada employment released at the same exact time. And with what this thing's doing, maybe we can finally clear out of this godforsaken range. All the hallmarks are there. We just need to see price start to follow through on the downside. Okay, next downside targets 33.88 and 33.70. Look for a bigger reaction down here. On the daily charts, look where that shows up, right in this range. Questions on dollar CAD? Expect some possible kickback on these. That's number 5. Let's go back to number 6. Here's dollar yen. That one is, so the weekly charts, nothing really to look at here except for the 2017 low week close. That's on all my charts, so I'll show you that in a moment. But you can see the pivot break that we saw last year was instant resistance the following 2 weeks, was resistance on the way up in April twice before breaking, and that's the acceleration that we saw into the highs. Early in this year, we spiked well below it, but we closed that week in that range, and here we are again. Also note that basic slope resistance for the pitchfork that we were following off the 2015 highs. That It's been messy, but it looks cleaner on a close basis, also in that zone. So dollar yen coming into an area of support. Here's dollar yen on the daily charts. 2017 low day close comes in at 107.83. The 618 of this year's range for that flash crash we saw early in the year, that's 107.61. So on the daily chart, those are two levels you want to be mindful of. If we do dip lower, that's the daily close break we need to see for the next leg. As we get into that region, well, the short side becomes risky. And it's been a decent trade, dare I say it. The abomination looking real clean. Here's what the 120-minute chart looks like. And here are the levels that we kind of looked at last night. So, okay. So three levels. It's 107.84, 107.60, and like I said, 107.29 is not noted on the daily chart, but that's just 100% off the high. So if it's just two equal legs, that still takes you closer into slope support, just below the zone that we highlight on the daily chart. But on initial approach, well, the low registered last night at 107.84. We highlighted 107.84. Okay, so if you're holding shorts, again, you know, this is where you don't want to be overzealous. You want to take a little off the table. Stops above the weekly opening range highs would be an objective place to put it. If you get above 108.40, you're probably going to see that little bit of recovery. Bearish invalidations, the same thing that we talked about earlier in the week. So 109.01 is resistance. Bearish inval is 109.31. That's the low day close from last month, the early drop that we made in May. That converges on slope. That converges on the consolidation support. So if this was a near-term triangle or a consolidation breakout, you'd want to see resistance ahead of that. And dollar yen has just been remarkably clean. Here's the 240, just to give you a view of the slope that we've been in, how clean it's been. Both pivots on the median line were outstanding. Upper 75% line held resistance. Saw a little bit of a pivot there, held resistance super clean early in the week, but here's the drop. Divergence. Yes, it's below 30, so it's not a strong signal. It's not a reason to get long, but it's a reason to be cautious on shorts. And if you're holding shorts, I'd peel off more at 107.60 and 107.30. I mean, those are both levels that I don't want to, you know, bank on the break because there's a higher probability that we'll see some sort of reaction there. All right, so dollar yen with some clean moves. See if that offers any guidance. Again, I'd like to sell a larger recovery. If you're holding shorts, the downside targets are unchanged and noted from last night. Okay, questions on dollar yen. That is number 6. Number 7, here's where we're getting the juicy stuff. Okay. We're making good time today, guys. Let me know if you have any other questions. We're breezing through this. Gold. Gold, 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 gold. What a clean breakout. So things to look at. First, the weekly charts. I'll be putting a piece out on daily effects on this later today. The level that came into reference, well, we can actually drop that 100%. We just broke that high, so let me get rid of that. Was the high we closed. 1327.63, that's the high that we made in February. We registered a high so far in overnight trade, pushing a little higher, 1328.95, just a bit higher. But this is the level that we need to keep in focus, okay? The trade is constructive basically while still above that slope line. Weekly chart, if anything, suggests that be cautious on the long side here. You know, it's a decent breakout, which I'll show you in the near-term charts, but the advance is coming into initial resistance. It's sort of the name of the game on every pair. Same thing with the DXY, same thing with the Euro, same thing with the Aussie. They're all, you know, looking to validate decent breakouts, but certainly the pullback. Hey, Peter, can you look at the SPX if you have time? You got the bottom right. Thank you. Yeah, Peter. Oh, it was the other Peter that was in the room earlier. I got you. It's already on the list, my man. 100%. So Aussie, gold rather, so super clean. So super clean. Here's the daily chart. Okay, again, the high we closed 1327. The median line break for that pitchfork, I just left the median line there. The upper parallels aren't even on it, but you could see how clean the pivots have been. Another breakout, really nice move. Here's gold on the intraday that we showed last night. We said that not only was 1327 the high week close, but it was also the upper parallel. Now, we don't have much, I want to say, to work on with this slope yet because we haven't really seen major inflections. Really nice inflection point there. The breakout of the 25% line did charge acceleration. The breakout of the median line did charge acceleration. We spent 2.5, 3 hours holding that 618 before the final pop. So our inclinations, our suspicions to be careful on the long side last night, I think were well warranted. I still think they are. Couple things to note though. Momentum is still in overbought conditions, even on the 120 minute, if I'm not mistaken from this morning. Okay, we just broke below. So that's something to look at actually. But the whole point is, it's the same trade that we're looking at, guys. The move is extended. It hit the first sort of major confluence region. Look for the pullback. Ultimately, still constructive above 1305. Bullish invalidation at the weekly open, basically 1302 if you really want to play it safe. And the next upside targets are pretty darn clear. The yearly high day close comes in at 1337. And the high close, note the difference, is 1341. Both of those converge on slope basically into the start of next week. So in the meantime, could get some softening, could get some play on the downside actually. Ultimately, if you're more of a swing type of guy, you're looking for that pullback to get long somewhere closer to the median line. Once we start, how do I say this in a way that makes sense? If price finally gives us some sort of near-term reversal signal, like right now it's an expanding pattern, so you don't really have it yet. But if you do get it, tack on a retracement and see where that converges, if anything, on the median line. That would be the ideal scenario for the play for the resumption. But man, what a move. What a move. Also note that the move that we saw over the last 2 days was an objective break of the May range. You see how clean the May opening range was? Boom. You set a high by the 14th of the month or the 13th of the month. We sat in that range right into the close before this pop. So ultimately, you know, as we noted in the second quarter forecast, we're looking for a low in the second quarter. I think we're getting that validation with this move here. So on the pullback, look for some cleaner support. Okay, that's everything that's on my list, or the things I'm paying close attention to here as we start off the month. Your questions. I do want to cover crude and SPX here for Pete. If you guys have any other trade setups you want to throw on the message board, feel free to. Here is crude. Like I said, the near-term chart isn't all that clean, but I do want to bring your attention to some longer-term targets that we've been talking about. So here's crude. Here's the real big breakdown that kind of changed everything that happened in late May, and it was the break below 60.61. So near-term resistance, we're still looking for 55.50, 55.21. We didn't quite hit the 618, and that retracement comes in at 51.60. So just key levels to highlight on the weekly chart that we would need to validate on a close to change things up. Okay, here's oil on the daily chart. Quick reference to a note we just said, downside break of a descending formation, typically the sharpest part of the move. There it is. Again, didn't get that 618, which is where I still think larger support is at this point. You're still in oversold condition. So your basic inclination on this one is to look for a larger recovery to get back on the short side, something to get a decent stop up. I can't get a stop against anything comfortable really here except 55.50. which is what we just talked about as our bearish inval. That's where slope was. That's sort of the level that would change things. So let's do this. Let's get rid of that. Clean this up. So that's sort of what I want to see. I think it would be a decent larger recovery play off of here if you get the stretch lower, especially if it happens without any sort of recovery here and kind of just jerks lower either today or tomorrow. Look for exhaustion. If we get towards 55.50, that's where I'd start to look again for some possible upside exhaustion for the next move lower. The near-term chart, here's the intraday. So again, there's that break of the downslope, accelerated drop, seeing some consolidation here. I don't think you quite get as high as 55.50, but I guess at this point, this slope is kind of null. And let's just see if there's anything here. All right, so some crude prices consolidation here. Ideally, like I said, it gets that drop first before it starts to rebound higher. If it does, 55.53, 57.36, that would be bearish inval. You'd look for a larger recovery back up towards the 60 handle in that scenario. Okay, so that's crude. Not much clarity on the near-term prospects after such a big move, but look for failure ahead of 55.50. Okay, SPX, Pete, here's what it looks like. That's going to be number 9. So, first of all, thank you. I didn't call the bottom. I just helped you find the level. The level that we talked about yesterday and last week, and if you remember, Pete, even when we were first breaking down, I even said it's a long shot. And people are going to get people always get mad when you get bearish with a move on equities like this, obviously for reasons that are pretty known. But anyway, 27.20 into 27.30, that was the sweet spot to look for the low. The low registered at 27.28.9. So we literally dipped our toes right into the zone. It held. You saw some consolidation back and forth yesterday. And like I said, you probably see some upside here. So no change to that outlook, Pete. I still think you look for, don't stress 27.86 as the March open resistance, but more so that 27.92 level. That's sort of your first, pivot zone, let's call it. And then this would be the sweet spot where I think if we do stretch, you'd really start to get more heavy on expectations for a short. And again, it would also make sense that it would start to fake everyone out. Everyone would start to think, oh, here we go, V bottom, markets have rebounded. The shock of the interest rate cut or whatever is finally starting to fuel markets. Remember, interest rate cuts, guys, are soft markets. That's better for equities. So, you might see some of that rebalancing start to provide a lift or at least some sort of catalyst, as it were, from the fundy guys for an advance. But even if it gets as high as 28, okay, 28.12, 28.21, I don't want to necessarily stress this zone, but even if it were to get this high, it'd still be within the confines of the broader downtrend. So don't get fooled, okay? Now, if we start to get some real constructive price action, we kind of plow through resistance, maybe you get a scenario where it's like this. But don't forget, people are going to start to look at this and say, oh, here's an analog of what happened last time we made that kind of doji type of trade into the lows and then rebounded. Yes, but we're in a different part of trend. This was a breakout, okay, from earlier in the year. Pushed much higher. We were within the confines of an uptrend. Yeah, uptrend resistance. That's the kind of bounce you'd expect to see resumption. But this is downslope support. So exhaustion would be what you would look for on this recovery. So long story short, Pete, no change from yesterday. Okay, I think that You look for 2786, 2792 for a reaction there. Bearish invalidation, unfortunately, is still all the way up at 2812, 2821. Hello, Michael. Question: how does the Fed rate cut will impact SPX, Paulo? So typically, softer rates are good for stocks, right? Think about it logically, Paulo. Why would I put my money in an asset that has risk if I'm getting a higher yield from the government, which is a risk-free, quote unquote, investment? So as interest rates rise, that tends to weigh on stocks because it saps money from the equity markets. Whereas as interest rates fall, well, I'm not going to put my money in a bank and get 0.7% or 1% when I could be higher, looking for yield. So just always think about it like that. So softer rates should be good for markets, right? But the thing that we want to note is that everything's lagging. Like we've been calling this for a while, that we're not going to get an interest rate hike or the two hikes that we were expecting heading into the start of this year. It was just a fantasy, but the Fed had to talk what they had to talk. Now markets are starting to price in finally what the real scenario is here, right? Well, that's not when you want to start getting, that's not when you want to start playing that theme. That typically as the masses hear about, remember, the markets don't reward the masses, right? So as the theme starts to get out there and everyone starts to sing the same tone, that's where you want to ease back a little bit. So my point being is that we've known interest rates are not going to be moving higher, but the markets have been breaking down nonetheless. You want to blame China, the tariffs, you want to blame the New Mexico tariffs, you want to blame whatever you want to blame, that's fine. We're following price. So Paulo, I'm always down to get into the weeds with the fundies and the conversation of how this could impact this, but I just want to tell you, our prospects as traders is not really to try to dictate what Fed policy will be, what's the impact of, higher inflation here. Those are things that make good storylines, that make good headlines, make good stories, articles to read. But from a trading standpoint, we always need to be focused on what price is saying. I'm not trading the Fed, I'm trading price. Now, the Fed is going to have impact on price longer term, but from a trader standpoint, we're looking for opportunities in near-term price. That's what we're looking at. My point being is that interest rate expectations, Paula, changed last week to start pricing in expectations for a cut, really a lot of cuts, not just one or two. Or actually, I should say the prominent expectation is for one cut at least, but it's starting to grow for two cuts. My point being is that we knew that last week, but the markets were still dropping. So if you were buying last week or trying to take even intraday positionings, you're going to sit there and say, well, they're going to cut rates, so that should be good. It would have been a really tough time into the close of the week. Just so happens that we came into a major support zone. So sure, if you try to take a thematic approach with every trade, Paulo, that's my only concern with focusing too much on that. That being said, this is your spot. Definitely feel free to ask any questions that you want. But I just want to make sure that we're always geared in trade into a trade-oriented posture. Okay. So immediate targets on the upside. Okay, Pete, if we fail here, you still could get a drop into the zone before a larger recovery. That's the one thing I do want to also note. If it's just too clean for it to be an exact 100%, two equal legs, then just a resumption all of a sudden. So don't be surprised if we see failure here to actually stab and make a new low before this thing turns. But the levels, I think, have been really clean. That downside formation is just, for an equity indice, not so bad. Peter says, thank you. Paulo says, okay, thanks a lot. Hey, more than welcome, sir. All right. Well, if there are no other questions, or if you do have a question, feel free to drop it. But if there are no other questions from here, we'll wrap it up. Don't forget, Jamie's on tap next week, or tomorrow, excuse me, for the weekly strategy webinar. And then I will be back on board on Thursday. Till then, don't forget, on Thursday morning, we do get the ECB interest rate decision. You get Aussie trade balance data tomorrow night. But more importantly, the thing I want to note is tomorrow you do get the ADP employment, which is typically a nice foreshadow for NFPs, and then keep big positioning or stay light and nimble until we get into that Friday. Once we close out the first week of the month with non-farm payrolls and Canada employment and all that good stuff, I think hopefully we get some definitive price moves off of these big levels. All right, guys, we'll wrap it up there. Best of luck trading, and I'll see you on Thursday. Cheers.